Hi, everybody. Good morning. We're just going to give it a few minutes to let everyone filter in from the waiting room. So we'll get started in like 2 or 3 minutes. Hello, everyone. Just another quick reminder, we're going to give it a couple minutes while everyone filters in from the waiting room, and then we'll get started in like 2 minutes. Okay, we still have a few people filtering in, so we're going to get started at 9:05, um, I guess Pacific time. So 2 minutes, noon or 12:05 East Coast time for those on the other coast. All right, just another minute and we'll get started. But how is everyone's day going? I'm so excited to kick this off with tax. This is so timely. Lots of big changes coming for this year. So, I guess also please send me any and all questions in the chat. I will be answering questions throughout the webinar as well as at the end. But I'm so excited to see everybody. We'll give it one more minute. Okay, we are going to go ahead and get started. It is 9:05. Let me screen share and get our slides up. All right. Happy Monday, everybody. Welcome to our One Big Beautiful Bill highlights. The focus of today's webinar is going to be what high-income parents and homeowners need to know. But I've got a lot of information about the bill in general, or the law in general, and what's to come and what's to change. And I'm going to walk you through some real life, real examples based on some real client situations. So let's go ahead and get started. Thanks for joining. So just high level, what I want to chat through today is standard deductions versus itemized deductions. That's going to be a huge part of our conversation. Everybody takes a deduction when they file their taxes. So this is going to be super relevant to every single person on this call. But then there's going to be some details that are relevant for different types of people based on your situation. So I'm going to walk you through a few examples and what your taxes might have looked like prior and what they're going to look like moving forward so that you can take some of this information and plan accordingly because things are going to be changing for a lot of you. There's also a lot of changes coming that will take effect next year. So I'm going to walk you through some of those so that we can start to think ahead. But today's focus is really going to be on what is going to actually affect your 2025 taxes because there are quite a few changes that will affect this year. And then we will do more webinars later to explain everything that's to come, but I'll give you a little preview so you can start thinking ahead. And the key takeaway here is to understand that you need to have a strategy. So I will show you how different scenarios can affect your tax outcome, in particular with the standard versus the itemized. So for some people that may be taking the standard deduction, and for some people who might not even know what a standard deduction is, I'll walk you through that. But we'll talk about why it's important to know the differences here so that you can take advantage of all of this on your taxes. All right, let's get into it. Well, One more quick disclaimer before we jump in. This is for illustrative and educational purposes only. This is not tax advice. Everyone's situation is different. If you do want personalized advice, we do offer that at Domain Money. So you can book a free strategy session and we will jump into your unique situation and what makes the most sense for you. But just keep in mind that this is all examples and illustrations to help you understand the tax bill and what to start thinking about. And if you want to read the really long bill, we've got a link here for you as well. But I'm going to give you the summary. But if you want to dig into anything else, that's there. So the first thing I want to cover are standard deductions. And this is what essentially everybody has income, and not everybody has income, but if you have earned income, everybody takes a deduction against it. Whether you take the standard, which is just kind of the default, if you will, or if you want to itemize, if you have other things that the IRS says you can write off, then you would do the itemized. Typically, I always recommend looking at both options to determine which one will give you the better outcome. So this is really important if you file your taxes on your own because you'll want to make sure that you're looking at both options. If you work with a CPA, they should be able to help you analyze those two options. But if you do them on your own, it's really important to pay attention to what might be applicable in the itemized deduction. But let's just start high level. So in 2017, the Tax Cuts and Jobs Act was put in place, and that is what a lot of our current tax code is based off of. And that was set to sunset next year. So this year, things were going to kind of be similar to what you saw last year. And then next year, they were going to drastically change. The One Big Beautiful Bill made several pieces of the Tax Cuts and Job Act permanent. So some of the things that you're used to will be here to stay, but then it also added in some other things that will or just give you more opportunities to maybe lessen your tax liability. Um, Before we get into the specific differences, I did want to just chat on what the difference between a deduction and a credit is. So, things that you can deduct from your income essentially says this portion of my income is not going to be taxed. So, if I make $100,000 and I deduct $20,000, then I'm going to pay taxes on $80,000, right? A credit is actually a dollar for dollar offset on the taxes you owe. So if you owe $5,000 in taxes and you have a tax credit for $4,000, then you only owe $1,000. So a credit is much more powerful and will put much more money back in your pocket. So just to give you a quick example, if you have a deduction for $4,000, you'll save somewhere between $900 and $1,500 on your taxes that year. But a $4,000 credit is actually $4,000 in savings. So, almost four times what the savings might be. So I just want to make sure that we all understand that because when you're thinking of different things that might be applicable to you, it's important to understand how valuable the credits are and how a deduction works and how it could benefit you too. All right, moving right along. Let's get into our first client example. So this is going to be just very straightforward. We've got Zara and Kai. They're married filing jointly. They make $200,000 combined, and they're taking the standard deduction. So to kind of set the stage, this is just for federal tax purposes. So we're not talking state just yet. Under this gray column here is essentially what their taxes would have looked like this year if there were no changes to the tax code. So they took the standard deduction and they did it depending on each scenario. I ran it for with kids, without kids, with more kids, just to give you a flavor of how this affects your tax situation and how it might change based on your personal family situation. But essentially, the Tax Cuts and Jobs Act, when it was going to sunset, it was going to revert back to the old standard deductions and personal exemptions that we used to have. So for a couple making 200K, you could have expected to pay about 27,000 in taxes this year. And then next year, that would have jumped up to 32,000 if everything else stayed status quo. Under what has now changed under the new OBB, the federal tax liability is actually going to be less than it would have been this year. And this is because they have essentially raised the standard deduction and increased it and made it permanent. So you get to deduct a little bit more of your income every year rather than it falling backwards. So I think this is really important to understand. This is an extension and a bit of an enhancement of savings that you're already used to. So if we look at just the Tax Cuts and Jobs sunset for 26 versus the new, there's a range here, a savings of 6,000 to almost $10,000. So this really does put a lot of money back in your pocket, but it's not necessarily tangible that you would have seen because you are used to paying lower taxes now. So you were about to have to pay a lot more in taxes next year, but they basically extended and made a lot of this permanent so that you can not only take advantage of what you were kind of used to, but actually in all three of these scenarios that I ran, you end up a little bit ahead with the new tax laws. So again, the takeaway here is just that it's an extension and an enhancement of what you're used to. But I do think it's so important to understand your personal situation here because it does look different for everybody and you don't want to be hit with a tax surprise. This is one of a little plug for working with a financial planner. Taxes can get very complicated, but certified financial planners can help you run these projections so you know exactly what your personal tax liability is estimated to be. It may not be exactly what you end up owing, but you can have a very good idea of what ballpark you should generally be in so that you don't get hit with a surprise in April. All right. So, I guess before I move on, are there any questions on standard deductions versus before I jump into itemized deductions? It's just kind of the default. I think, there's not too much to dig into because it is just this is what you're essentially allowed to take. Josh, do we have any questions in the queue or are we good? Okay, perfect. We will get into itemized deductions then. So if you have certain other instances or certain other expenses, you can opt to take an itemized deduction rather than just taking the default that you are opted into. So some of popular itemized deductions that you might be familiar with, and if you're not, there's definitely a few more that go into it, but these are the most common that definitely affect the most people. Is medical expenses over a certain amount, charitable donations, mortgage interest, and then income taxes that you pay to the state or to your city, and then property taxes that you pay on your house. So if all of these add up to more than what the standard deduction is, then you can opt to take the itemized, and that way you have less income that is subject to the income taxes at the federal level. Now, one thing I want to talk about is the SALT taxes because this is a huge focus of the new tax laws. There are changes to a few other aspects of it, but the biggest change is related to SALT taxes. And SALT essentially it just stands for state and local taxes. So it includes both of those two items I mentioned, your income taxes that you pay and your property taxes at the state and local level. So historically, you were only allowed to deduct $10,000 of income and property taxes combined on your itemized deduction every year. So a lot of people ended up opting to take the standard higher than what they would do if they were capped at that 10,000. Now, under the new law, that $10,000 cap jumps up to 40,000. So there is an opportunity here to deduct a lot more of these other expenses that you maybe weren't allowed to deduct in the past. So I'm going to walk you through a client example too to give you some context here of what this looks like and how it might be different. But this is really important for people who live in a high income tax state or people who own their home. Those are really that we want to definitely make sure we're looking at your itemized deductions for this year. Even if you didn't itemize last year, it might make sense to this year. So this is a really important tax planning opportunity that you don't want to miss when you go to file your taxes. One quick note, it does start to phase out if your combined income is over $500,000 married filing jointly, and it'll eventually work its way back down to that $10,000 cap. But if you're under $500,000, then you can go all the way up to the $40,000 cap. Okay, let's get into another client example. So to set the tone, we've got Iris and Jasper. They are married filing jointly as well. They're making about $328,000. They live in Minnesota. They recently bought a $675,000 house, and they've got a mortgage at 6.625% with a $460,000 balance. So hopefully this kind of sheds some light into the type of person this deduction increase might impact the most. Start with just exactly what's included in their itemized deduction. So right now they're paying state income taxes of about $17,500 over the course of 1 year. Under the old tax code, it's the same as it is under the new tax code. This is not affecting their state income taxes right now. The property taxes they pay on that home they own end up being about $9,000 for the whole year. So that's the property tax you pay. It's usually baked into your mortgage, but essentially the property taxes they pay to their city or their county are 9 grand. So their total state and local taxes, or also referred to very often as SALT taxes, is just over $26,000 a year. So again, no changes across the board. This is just strictly what their expenses are in taxes for these various items. Under the former tax code, they were only allowed to deduct $10,000 of that $26,500 that they had spent on all those taxes. Under the new tax code, they're capped at $40,000, so they can actually they can't take the full 40 because they didn't pay 40 in SALT taxes, but they can take the full 26,500 that they did pay in state and local taxes. So they have a deduction increase of 16,500. So if we go back a couple slides and think about what is a deduction, that just means that over $16,000 of their income now will not be taxed. So it's not a tax credit of $16,000, but there is a big chunk of their income that now will at this. Okay. Now, to take it a step further, they do have mortgage interest that they're paying as well, which is also deductible on your itemized tax returns. And so they're paying about $25,000 of mortgage interest this year because their mortgage is new. You pay a lot more interest on a mortgage each month than you do in principal when that mortgage is new. I could talk for hours on that, so we'll save that topic for another day. But essentially, the mortgage interest that they're paying to the bank is also deductible. So this is important because it's significantly increasing their total deduction that they can take as well. But it's the same in either situation. So in the end of the day, their deduction is essentially increased from, they would have been able to take a $35,000 deduction before. Now they can deduct over $51,000 on their tax return. So that's, again, over $16,000 of income that they won't be paying taxes on that they were before. What this boils down to in their actual tax liability, it's about a $4,000 savings over that course of that year. So they would have owed almost $48,000 hypothetically in their taxes based on the old tax code, and now they're going to owe less than $44,000. So if you are a new homeowner, you pay property taxes, you have mortgage interest, and you also pay a significant amount of state income taxes, it's really important to understand this so that you can determine if you should be itemized. A lot more information that you need to share with your accountant or upload to the software that you're using to file your taxes, because you need to give them all this information in order to actually get credit for those taxes that you paid. So something to pay attention to if you are a homeowner or live in a high income state. All right. Now, oh, we have a couple questions. Okay, let's take a pause then for just a second and answer some of these questions that we've got coming in. Okay, so let's see. For Iris and Jasper, it's not really 16,000 if we consider the standard deduction, which was around 28,000. So there is a difference between the standard and the itemized deduction, right? You take one or the other. So if we look at, let me go back to my example here so I can explain this a little bit. Let's go back to, okay, so for Iris and Jasper, so that is a good question, but if you see here, the total deduction under the former tax code, they were going to be able to take $35,000, which is more than what the standard deduction was at about $30,000. So either way, they would have been itemizing. So it is still a 16,000 increase. If we wanted to compare this to the standard deduction of 30,000, then actually they would be deducting about 21,000 more under the current code versus the old standard deduction. So it is still a significant increase from that. But that question may have come in before we were talking about the mortgage interest. So that's kind of the differentiator there. Let me see what else we've got in the queue. Okay, so what is the standard deduction going to be? So moving forward, For this year, it's going to be 31,500 if you're married filing jointly. It's essentially half of that if you're single. I can follow up with a resource for all of the brackets and the deductions for this year so that you can get a better feel. But this is really, if you are having questions about which one's right, this would be a great time to work with a financial planner who can help you with these projections. And maybe it's time to work with a CPA as well, or someone who can help you file your taxes if you fall into one of these buckets, to make sure that you get it right and can actually capture these tax savings. Okay, let's get back into our slide deck. Okay, so moving on, we're going to take that same scenario, but I'm going to give you a different client example to show you that it's not the same for everybody. So now we've got Ren and River. They're married filing jointly. They make a little bit more dollars. They live in my home state, Ohio. They bought a house a few years ago, so they do own their own house. It's about 500K. And they have a mortgage with a significantly lower interest rate than our last clients. So their interest rate is sub 3, which is not uncommon if you bought your house, 5 or 6 years ago, or even, 3 or 4 years ago, maybe. And so let's take a look at how their tax situation compares and how much they're going to potentially save under the same exact scenario. So state income taxes in Ohio are less than they were in Minnesota for comparison. So they're only paying about $11,000 in state income taxes. And their property taxes are also significantly lower. So they're paying about $1,500 a month, or I'm sorry, a year. So $1,500 in total. So their SALT taxes are only about 12,000, a little over 12,000. So under the old code, they would have been capped at 10. So under the new code, great. They get to take an extra $2,400 of deductions this year. So it's up a little bit. But then if we look at, again, adding on the mortgage interest, because their rate is so much lower, they pay a lot less in mortgage interest. So their itemized deduction under the old code was about 18,000, and under the new code, it's about 20,000. And this is a perfect example that both of those numbers are less than the standard deduction, which used to be 30 and is now 31,500 for this year. So their tax liability this year will be slightly less, under the new code will be slightly less, just because the standard deduction was increased slightly, but they're not itemizing. It doesn't make sense. So even though they own a home and they pay state income taxes, this is a great example of how everyone's situation is different. And it's really important to understand all these differences, because you might not know whether or not this client, for example, has not been itemizing their taxes over the years, but they don't necessarily need to, so they don't need to get into all of that. But the first client, they were taking the standard deduction before, and now they're going to get a lot more benefit if they do provide all of this extra information and do the itemized deduction instead. So again, just a great example of why it's so important to understand your unique situation and work to understand how these changes will actually affect you. It's not enough to just know the tax code or know what's changed. You need to understand the strategy behind it and how it affects your unique situation. Okay, so I'll pause there for just a second and see if there were any other questions, because I do want to move on kind of from standard versus itemized deductions and touch on a few other topics that are timely and relevant and more to come in the new tax code changes. So let me just take a quick check on the questions and see if we've got anything new coming in. Okay, so we've got a question about for married filing jointly, if the standard deduction is 31,500 and the SALT under the itemized deduction is capped at 40, so the benefit is only about $8,500. So this is actually not quite the case. Let me jump back to another slide here that I think will help you understand this piece. So I don't have the standard deduction on here, but in theory, for this situation, the standard deduction would be that 31,500 that you're referencing. While SALT is capped at 40, the mortgage interest is not part of the SALT cap. So they get to deduct their mortgage interest on top of those SALT taxes. So in this specific example, they actually have about $20,000 of benefit rather than just that 8,000. So the benefits of the SALT increase are, but if you're comparing just standard deduction to itemized, there is more that goes into it. So great question. Let's see. I think there was one more. Let me take a look. Oh, and I apologize. I don't think I had my screen share paused. So this is, let's just do that one more time. This is exactly what I was trying to explain. 51,500 because you have the extra mortgage interest on top. It's still a lot more than the standard deduction rather than just the 8,000. But the SALT increase has about a $16,000 benefit there. Okay, let's see. Okay, what is the benefit if you live in a no income tax state? That is a really good question. So, example, there's so many, there's a lot of different ways to kind of go about this, but I'll go one more slide here. Property taxes. So Texas is a great example. Texas does not have income tax on the at the state level, so you're not going to pay Texas state income tax, but you do have property taxes. And actually, property taxes in Texas tend to be higher than in other states. So this SALT benefit is a combination of your income taxes and your property taxes. So if you own a home and you pay property taxes in a no income tax state, then this could still benefit you. But if you don't own a home and you don't have an income tax in your state, then that you may end up taking the standard deduction and be better off that way. But that's absolutely something that we can do an analysis for and help you figure out. I will say with one caveat too, though, because charitable deductions are also a part of your itemized deductions, that if you're charitably inclined, there may still be reasons to take the itemized deduction. So this is really focusing on the SALT taxes because that's the biggest change that will affect a lot of people in the new tax law. But there's still much more that goes into an itemized deduction than just state income taxes. Okay, let's keep moving along. I want to touch on the new accounts that have been established, and this will be for 2026. And I will take more questions at the end, so please keep them coming in. But one of the big changes that affects how we think about our strategy and financial plan establishment of a new type of an account. So there's no shortage of types of accounts that you can invest in. A couple of the more popular ones, right? A 401k plan or a 403b plan at work, or an IRA or a Roth IRA or a regular brokerage account. There's lots of options out there. And part of financial planning is figuring out which is going to be the best strategy for you and what type of accounts your money should be in. And there really is no one size fits all when it comes to this because it really depends on what your unique goals are. Do we want to optimize tax savings today? Do we want to optimize tax savings in the future? Do we want a mix of both? And what time do you want to retire? If you plan to retire super early, you don't necessarily want all your money tied up in a retirement account, things like that. But the new account that I want to focus on that has been established, the as far as I can tell, based on the law right now, the official name is called Trump accounts. So that's what we're going to go with here. It is a new retirement account for children. The big difference between this and what some of you may know of as a custodial Roth IRA, which is also a retirement account that you could set up for your children, is that they don't need to have any earned income to contribute to this. So before, you would have to essentially have your child on the payroll, or they would need a summer job in order to put money into a retirement account for them. But now, under this new type of account, you don't have to have any income. Anyone can get a contribution as long as you're under. One of my favorite pieces of this new type of account is that the money has to be invested in low cost index funds. They have a maximum fee of $1 for every $1,000 that you have invested. And fees on funds can really eat into your return and your account growth over time. And sometimes they can be $100 on 1,000 invested. So it can really affect your long-term balance in this account. So I think it's really important. And I love that they have a cap on this so that it is a low cost index fund and you will essentially be tracked. They're all meant to track a part of the stock market. And there's a $5,000 annual contribution limit. So you can't throw a bunch of money into this account. You can't put your whole salary into it for your kids, but you can put up to $5,000 a year. And one other really cool feature is that employers can actually make contributions to these accounts for you as well. So just like an employer does a match into your 401k plan, employers can add money into this account for your children. And so this is something I'm a huge fan of, looking at your entire benefits package when you're changing jobs or if you're looking to potentially change jobs, because there are a lot of unique ways that you can get extra dollars, whether it's from a 401k match or contribution like this, or type of health insurance that they provide, things like that. So it's very important. And this could be a cool negotiating tactic when you're looking at your next job too, to see if you can get some extra dollars that wouldn't be compensation or taxable to children. An important thing to notice is that there is unlimited access in these accounts at 18 if it's for higher education. However, you will have to pay taxes on it. So there's no penalty, but you have to pay taxes on the growth at that point. So I do want to note that a 529 plan might still be the elite college savings vehicle, but I also want everyone to remember that what's most important is what your goals are and what you're trying to save for and what kind of flexibility we want or how firm your specific goals are, and then we can figure out what type of an account is going to make the most sense. Another caveat to these accounts is your children could also access $10,000 at 18 for their first time home purchase. So if you do want some flexibility and you don't want it to be just for education, this could be a good alternative rather than doing some of the other accounts that might have more restrictions in them. And one other catch that I feel like has been a super popular topic when it comes to these accounts is that for anyone born after January 1st of 25 through the end of 2028, the government is also funding it with $1,000 today, which I've heard the argument, it's not that much. It doesn't, it's what's essentially the point or how does this actually benefit me? So I ran some numbers and assuming you did have this money invested in the stock market, $1,000 today, if you were to average 7% every single year, which is a conservative estimate of what the stock market has averaged over the last 50, be about $58,000 in 60 years. So by the time, if you had a baby this year, by the time they're 60, that $1,000 could grow to 60, almost $60,000 if it wasn't touched. And we do want to account for inflation though. So $60,000 will not feel like $60,000 60 years from now, but it will feel like $10,000. And that is a very nice vacation, if you ask me. So celebrating your retirement with an awesome vacation that did not cost you a dime, I'm all for it. So the government will be in theory, automatically funding these accounts for children starting next year when they're available. But keep an eye out and make sure that you get that money for your kids, especially if you have kids that were born at this time period, and make sure that you get it invested so that it's not sitting in cash, because that's also a huge, important piece of the puzzle. So just a key takeaway here, there is again, no one size fits all. This account might be beneficial for you, but there are so many other account types that you should really make sure you have a good understanding of your goals and which account type is going to be the best fit for you before you start putting extra money into it. Okay. Let's just cover a couple of other miscellaneous changes because I want to put these on your radar as things that will be changing for 2026 if they apply to you so that you know to stay in the loop and keep up with what is going to be changing. There is going to be a new deduction for overtime pay. So if you work a job and have overtime pay of $12,500 if you're single or $25,000 jointly, you will get to deduct this and not pay taxes on that first chunk of your overtime pay. If you make $30,000 in overtime pay and you're married, you will still have to pay taxes on $5,000 of that. Very similar, but it works a little bit different in practice for tips. But there is up to $25,000 of tips that you won't have to pay taxes on as well. One of the big 529 plan changes is you were allowed to use $10,000 out of a 529 plan to cover K through 12. So if you had private school for your children and you wanted to tap into that to help pay for it, they've bumped this up to $20,000 a year. So it used to be 10, they basically doubled it. Now you can just tap into your 529 a little bit more if you need help paying for current education. Another new one to drive interest in purchasing cars assembled here in the US, there is going to be an interest deduction for car loan interest. Very similar to that mortgage interest deduction I was walking you through in the examples today, where if you paid interest on a mortgage, you could deduct it on your itemized deduction. This will be rolling out for car loans moving forward. So important to think about it when you're going to purchase a new car. If you are going to be financing it, look at your options, see which ones would qualify for this interest deduction if they're assembled in the US or not. But it's obviously a personal preference and how it's going to affect you. So again, no one size fits all. And then the last one and most timely is the clean vehicle credit is going to be eliminated effective September 30th of this. So if you are planning to or wanted to buy a new EV, now would be the time, and make sure that you get it done before that September 30th timeline. Or if you are considering it, definitely run the tax numbers and see if it would benefit you to buy it between now and then so that you can take advantage of that credit before it is phased out under the new law. All right. So we went through a lot. Before I turn it over for more Q&A, I just wanted to highlight our upcoming webinar sessions that we have for the rest of this year. September, we're going to be covering open enrollment and employer benefits, which is huge, timely before a lot of open enrollments start in September, October timeline. So this will be a great chance to make sure that you understand everything before you elect for your benefits for next year. In October, we're going to be covering tax loss harvesting. There's so much that goes into this. There's so many types of platforms that you can access it through. So it's really going to be like a tax harvesting 101 so that you can really understand the benefits of it and how to utilize it. And then in November, we're going to be going over budgeting for the holidays and how to utilize Monarch Money. All of our clients do get access to Monarch Money as one of the financial tools that we provide access to help you with your finances moving forward. So this will be great if you're already a client or if you are going to be a client. We'll make sure that you know how to get everything set up properly so that you can actually get the most out of the app. And then in December, we're going to be doing a year-end financial checkup. So making sure that you know what you need to kind of close the loop on for the end of the year and also what to think about going into a fresh year. Okay. All that being said, if you do want personal financial advice, like I said, this is all for illustrative educational purposes. At Domain Money, we are certified financial planners and we provide customized advice every day to our clients. So if you are looking for something more personal to your situation, I would urge you to book a free strategy session and see how we can help you. I am going to go ahead and check. It looks like we've got more questions coming in. So please send in any questions you have, and I'm just going to start running through some of these. Okay. Okay, first question about the Trump accounts is who will be the holder of these Trump accounts? Can I open it, say Vanguard? So this is something that they have not come out with the full details yet in the bill because it is going to be for 2026. So more to come on this, but we are expecting it to be kind of like a Roth IRA where you can pick where you want to open it up at. So more to come on that, and we will definitely keep you posted once we have the details on how that works. But there's still more to be finalized with that. And then at what age are children getting these? Is it for all newborns or is it only effective as of what date? So any child up until 18, you can open this account for any children up until their age 18. The only ones that are going to be getting that $1,000 seed money essentially from the government is if you were born January 1st of 2025 through 1st of 2028. So anyone that is a minor, you can open this account for. But the requirement essentially is just based on getting an extra $1,000 to kickstart your account. That's where the age requirement comes in. Okay, let's see. What is the cap? There's some questions about the mortgage interest cap and the car interest cap. There's definitely a lot more details we could go into that. But there is mortgage interest caps if your home is valued over a certain dollar amount. I can follow up with you, Ravi, on some of those questions, and same for the car one, on how that all plays into each situation. But we definitely will be having more tax stuff to talk about for next year on all those other changes. So that was just kind of meant to be a little preview of what's to come. There's still a lot more details to come on how that will actually affect you and more details to come from the actual legislation on how it will impact clients and everybody. Okay, let's see. I think that was everything we've got so far. Any other questions, please send them my way. We'll hang on for a few more minutes and see if there's anything else. I'm also curious how many people are going to be attending our open enrollment. And if you are planning to join, send a message in the chat or raise your hand. I would love to see who is planning to come hang with us next month too. Okay, I think I got another question coming in. Okay, a question about what is the contingency planning approach if the tax changes don't pass as expected or get modified significantly? So everything that we went through today for changes that will affect 2025, that is already law. So that is passed. There are still ways to interpret different laws differently and how they will affect people. But in general, the stuff that we went over, that is already a signed law. It was not proposed changes. This was actually in effect. As far as the 2026 ones, those are also already technically law. It is just about how everything will be interpreted and put into effect as well. So, what I would say in this instance is it's very important to work with a tax professional and a certified financial planner who can help you map this out and understand it, especially in a year where there are different changes, in the tax code, because it is a much more drastic change compared to, let's say, 2024 to 2025. And then one other thing, I know we had promised and teased about a date on our webinar today. And so, a little preview into what's to come at Domain Money. Moving forward, we are going to be including tax filing in our strategic and our comprehensive memberships. So, if you're interested in having an even more cohesive, tied together strategy for all of your finances, we've always been open to working with your CPA and helping you with your taxes. Tax planning is a huge part of what we do. But this is a really exciting new offering to even make it even more close knit so that you have an extremely solid financial plan that covers everything and you can kind of have everything in one house. So we're really excited about it. We're going to be launching it, I believe, officially in September. So keep an eye out for more details on that. A lot of you will be filing taxes come April, but if anybody still needs to file for the end of this year, please reach out to me, send me a message in the chat, or let me know, and we can talk about how we can get that started as well. So super excited. That was a little teaser. Tax filing is going to be included in your membership now, and at no additional cost. So it is the same membership that you already know and love. So we're really excited about that added benefit and to make sure that you've got a super valuable team behind you. Let's see. All right, I think that's it for questions. Awesome. Well, thank you everyone for your time. I'm so happy to spend the time with you today. Really looking forward to our next session, especially with how timely and relevant it will be with your open enrollment coming up. So we will be following up. Make sure you register, get it saved on your calendar. Even if you can't attend, we will send you the recording as always. But register now and let us know. And feel free to reach out and send me questions in advance if there's anything that you have questions on in particular. I'd love to incorporate that into our conversation next time as well. So I'll see you in a couple weeks.